It is Fed Day today. Of course, the Federal Reserve is widely expected to announce moments from now that they are leaving interest rates unchanged. We're all anticipating
this. Although prices have steadily declined over the past 2 years, inflation still remains above the central bank's target rate. The last time the Fed changed interest rates was July 2023. Experts predict they will drop at some point this year. We just don't know when. But Chairman Jerome Powell says more time is needed for the economy to cool off. And we have two experts here with us in Studio 57 to break this all down. CBS News business analyst Jill Schlesinger and CBS News contributor and host of financial news website The Street, J.D. Durkin. Welcome to you both on this exciting Fed Day.
Happy Fed Day.
Yeah, it's kind of like the Super Bowl for you two. Jill, Americans everywhere, they've been waiting for the Federal Reserve to begin cutting. Why are we not expecting to see that today?
Well, I think that Jerome Powell and the rest of the Fed officials have been poring over data, and a lot of that data recently have shown that prices are staying stubbornly high, and even the rate of inflation, the rate of price increases, is not coming down to the level where the Federal Reserve would like it. And I think that until that happens, they are sort of saying, well, the economy's strong enough. We're seeing job creation. We're not seeing mass layoffs across multiple sectors. What's the downside of waiting another meeting or two? And I think that that's really the rationale. Remember, they've got to walk a tightrope, right? They have to make sure that they're keeping rates high enough to cool down the rate of inflation, but not keep them so high for so long that they snuff out economic growth.
Yeah, we were joking before that wouldn't it be the craziest thing if they decided to increase interest rates or even cut them at this point, because it's so well known that what we expect to happen today is unchanged. And given that, JD, are the markets even paying much attention? Is it having much influence today?
Well, the markets definitely pay attention. I would argue earnings season tends to be a bit of a bigger driver, especially in a case like this. We do have a few big names. We'll be following earnings the next few days from Nike and Micron as we move forward to April 12th. Finally, we get the big banks coming up over the course of just a few weeks. But in terms of markets paying attention today, they certainly are. We've been perfectly flat, which does not often happen, basically from the opening bell until just a few moments ago.
We do have the answer. Surprise, surprise, it's unchanged.
Absolutely. But as Jill and I were talking about before we came here live, this is also what we call the dot plot, or the summary of economic projections. This is the kind of anonymous survey where all the voting officials of the FOMC give their gauge. Where do they think inflation is going to go into the future? Where do they think interest rates will be? As Jill is very fond of pointing out, the Fed is oftentimes wrong, if not usually wrong, but it is important in that it can be market-moving information for the afternoon. Any type of pop that we might see in the major market indexes between now and 4 o'clock could be in direct response to that projection. And, of course, what Chairman Powell has to say at his press conference at 2:30.
And, Jill, this is now the fifth time in a row that interest rates have remained unchanged. And I'm just looking back at the numbers since June of last year. It's all been in the 3 range. I'm wondering how much that directly impacts Americans, these decisions.
Well, I mean, look, if you look at interest rates, they kind of impact every single American, because you're sort of either a borrower or a saver, right? So if interest rates remain high, it's tough to pay down that credit card debt. You know, if you look at $1.13 trillion of outstanding credit card debt, and you imagine that, 10 years ago, average credit card rates were 15, 16%. Now they're close to 23%. Right. That takes a big bite out of my budget. Conversely, if you're a saver, you're kind of psyched about this. We had this era of such low interest rates. You got paid 0 on your checking and your savings and your CDs. And this was essentially a period where a saver was penalized and almost encouraged to jump into the stock market because there was simply no other alternative. Now you're getting paid 4 or 5% for a high yield savings account, a short-term CD, a money market account. So interest rates really do have power over our lives.
JD, how do you expect U.S. investors to react to this news?
Well, it all depends on, I think, not just what the announcement was, but, of course, that question and answer portion, like we mentioned a moment ago, that press conference, because that gives the chairman of the central bank the opportunity to not have a script in front of him. The scripting is very important. The FOMC officials are always so careful what words get added, what words get omitted from previous meetings. But it's really as soon as you hit that question and answer portion where you start to get a gauge about what the path forward is. And I think that will be what we'll be very carefully listening for. Oftentimes during Fed days like this, we can't forget the first move oftentimes can be the wrong move, meaning we get that bit of information at 2 o'clock, 2:05. It takes a little while for the dust to settle before investors say, oh, that's actually where we should be putting our attention. It's not what we first thought. Chairman Powell gave us a bit more information, so that kind of remains to be seen. But a fascinating case study, I always think, that last 90 minutes of trading on Fed Day, or as you said, our Super Bowl.
Exactly.
Well, Jill, I'm wondering how much longer Americans are going to have to wait for those interest rates to be cut, especially when you were talking about the credit card debt, because consumers are still buying, and that's part of the reason why these interest rates are unchanged. It's all interrelated. Consumers keep buying, but now they're buying on credit cards, and they're paying higher interest rates on those credit cards.
Well, some are, right? So, yes, there are a lot of people who are carrying that, but yes, absolutely. Well, look, the Federal Reserve is penciling in 3 rate cuts before the end of this year. Okay, so 3/4-point rate cuts. We're at 5.25% to 5.5%. Take 0.75% off that. I think that the most likely scenario is if inflation data come in a little bit better in the next couple of months, that the Fed will say, okay, we didn't do anything in March, nothing in May, maybe June. Right now, we have a way to look at what the bond market is predicting about rate cuts. And there's about a 50% probability that June will be the meeting, or before this announcement, but there was a 50% probability that June would be the first rate cut. So, look, does it really matter if it's 2 or 3 or 4? Not to most of us. The most important thing is they start. And starting would mean, and a signaling to the market, okay, this period of high inflation and high interest rates is coming to a conclusion. And we are going to likely normalize before the end of not this year, but probably next year.
So what is your advice to Americans? And both of you chime in here, because the fact that the rates are now officially remaining at a 23-year high, what's your advice?
Well, I always say, first of all, I'm not a financial advisor, just as a reporter, but I think it's always a good practice to try and pay off your debt, especially in a high interest rate environment. We've had so many conversations here about people willing to drop the plastic, be it for Taylor Swift tickets or an experience out there. But those interest rates will kind of creep up on you if you're not as diligent as you can be about paying those off. And then hopefully, to Jill's point, as we finally get that indication from the central bank, rates are starting to come down, we can alleviate a bit of that pressure in the system person to person.
And then if you do have 0 credit card debt or you've paid off your auto loan, how about you lock in some of this money? Because if interest rates are going to come down and you know you have a tuition payment next year, or you know you want to save for a house, but you can't afford it this year, you need another year, lock in a CD rate, put your money in a high yield savings account, make sure while interest rates are high that you have your emergency reserve fund working for you. A lot of the big banks are still paying bupkis when it comes to interest, by the way. That's the official term. And so you should be looking for the best alternatives to that. Keep enough money in your bank account to get the freebies and don't get any charges, but get your money to work for you. Also, good news, if you're getting a tax refund, which you know is a bad idea because you just lent Uncle Sam money, if you're getting a refund and you know you're going to need that money, same thing, pay down debt, put some money in savings, get your money to work.
Makes sense. All right. Jill, JD, thank you both.
Thank you.
Thanks.